Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about what are the different types of life insurance. And to do so, we brought on a special guest. And Mr. Collins, would you like to introduce him?
Yeah, so this is Mark SanGiacomo. Mark and I have known each other now for 11, 12 years, somewhere in that neighborhood. When I first met Mark, I was struck by, wow, this guy is really arrogant and like thinks he knows everything. And then about 6 months later, I figured out that like he does know everything when it comes to life insurance.
I'm glad it only took 6 months. I've been married for nearly 15 years, and I'm still waiting for step two. But I'm glad that we've gotten there, Alex. Thank you.
Yeah, and so like initially, like I didn't like Mark very much because like he came across as a little bit arrogant. And now like we're good friends, and like if ever I have a question about life insurance, Mark is always my first call.
And Mark, to be fair, that's how most people feel about Alex the first time they meet him. So, you're in really good company.
Agreed. Alex is definitely good company to be in. I'll grant you that. I won't co-sign the other part yet, though.
Thanks, Mark. Thank you, Ryan.
So,
and you're not wrong.
I mean, I had to get my dig in somewhere. We know me well enough at this point. So, Mark, welcome to the show, man. I'm happy having you came on. I won't mock you like Alex did. I think you're a great person, and I won't talk behind your back like the way Alex does. I'm joking.
Well, I was talking right in front of his face.
That's fair. That's fair.
You say you're joking. I guess that means you do talk behind my back. But we'll put it aside and move forward from there.
So I'm excited for you to come on. As Alex said, on the product side of life insurance, like you are the person that we speak to a lot when we've got questions and design work and all that kind of fun stuff. So welcome to the show. We're glad to have you on. And the topic is life insurance, which our listeners are probably like, oh crap, here we go. Right. Because, I don't even like life insurance all that much, but it's what I do in terms of the financial planning side of stuff to make sure our clients are covered. And so I do want to get into product and questions and have you explain the different products because, Mark, I think you do a great job of explaining it. But before we dive into that, Alex, I think we should just start with a high level kind of like life insurance. Like when you're looking at getting life insurance, it's a replacement of income oftentimes, right? At least pre-retirement, right? And
100%.
So that's the first question most people have is how much should I get? And so
before we go there, Ryan, we are noticeably absent of adult beverages today. And that is because we are recording this in the morning, and for our health and you guys, we don't want to be drinking early in the morning. But yeah, let's go ahead and jump into the amount. And this is going to be kind of hilarious because like Mark is one of the people that talked about amount to us. But Mark, how is it that you go about determining the proper amount of insurance for somebody?
Yeah, absolutely. And it's a great question that most individuals, when they start a conversation about life insurance potentially for themselves, do not really know what the first step is, let alone the answer to. And if I'm sitting down with that sort of individual, the first question I will usually ask them is, why don't you tell me about some of your most valuable assets? Tell me about what you own, what you need to protect that is worth the most. And people will list their home, of course. They'll list their vehicles. As you might be able to tell right now, I'm sitting in an RV, and I would certainly list my RV as one of those assets. But very rarely do they state themselves. And what many people just fail to realize at the outset is that they are their own most valuable asset, because nothing that they own produces more for their household, for their family, than them getting up and going to work every single day. And what we focus on quite a bit in the way of life insurance protection is income protection and income replacement, which is a phrase that you all used before. So just as a hypothetical, sort of quick and dirty numbers example, if you're working with someone that is making $200,000 a year and they estimate that they're going to work for another 20 years, simple math tells me that their human life value, if God forbid something happened to them today, is $4 million of lost income for their family. And chances are, if you total up their residence, their vehicles, all their toys, anything else, it probably doesn't approach that $4 million. And remember that that's not taking into account inflation or increases, hopefully over 20 years, and not having stagnant income. That's the starting point, in my opinion. And that's not addressing possible protection of debts and mortgages and other things that we may want to protect. That's pure income replacement.
Yeah, 100%. Like one of the things that I was taught early on was like, okay, let's turn it into like almost like a retirement plan conversation. Like, okay, when you retire, how much income can you take from your retirement portfolios? And the traditional financial planning answer is, well, 4%. Okay, great. So for every $1 million of insurance that you have, that's going to replace $40,000 of income. Okay, well, what's your income? Use your example of 200. Well, we need 5 million to effectively replace that $200,000 of income. And again, that doesn't take into account inflation. It doesn't take into account increases and things of that nature.
A big part of this, what's really interesting is I see a bunch of other videos from other people that are speaking into this very topic around like how much life insurance you should have. And 9 times out of 10, they go into what we would call a needs analysis, where they're like, well, how much debts do you how much do you have in debt? How much do you want to leave behind for maybe your kid's education? Oh, how many years of income do you want to leave for your spouse? Which I think is a stupid flipping question. Your spouse should like take a pan up beside your head if you ask that question, which is sad because I used to ask that question. Like I'm mocking myself in this example because that's how I was taught. And so it's still being looked at out there, or it's every once in a while I see like the 10x where 10 times your income. And I'm just sitting here going, how did you die? Did you battle cancer for 4 years and exhaust millions of dollars trying to battle that? Or were you hit by the number 4 bus? Right? What changed over the lifestyle? What's occurring? Like there's so many variables that it's idiotic, in my opinion, to go. And this is a strong opinion, I realize, but like there's just so many variables in the very instant of, wait a minute, I'm wanting to make sure my family's taken care of. I'd rather have as much as I can within my cash flow reasons, obviously, so that they're taken care of. And Mark, I love your example. It's very simple. How many more years of income do you have coming in the door times the income that's coming in the door?
What a lot of people also don't take into consideration when thinking about that is they're measuring their own typical household expenses potentially against replacement income. If again, forbid something happens to one of the 2 parties in a 2-person household, the expenses don't go down. They tend to go up because the person that's not there anymore is not there to do a lot of the work and things that just have to get done on a day-to-day basis, not to mention the emotional toll that takes on the family and them struggling through that. Things are difficult for a while. People recover. People are resilient. I won't say that they're not, but it's not the same necessarily the same budgetary situation, especially from the jump that they were facing before.
Yep.
So Mark, what you're telling me is that like when you get up and leave the room, your wife doesn't shut off the lights and the TV and keep sitting there?
Not most days, no, Alex.
I mean, like we make jokes and fun out of this stuff, but at the same time, like it's important to understand that, yeah, like cooking for one is not a whole lot different than cooking for 2. Like a lot of the bills don't change at all. A lot of the taxes get worse, not better.
Mm-hmm.
And like, I don't know, I've been doing this a long time now. And I have, of all of the claims that I've delivered to clients, and even claims I've delivered to folks that like their advisors no longer in the industry, so I delivered the claim. Absolutely 0 of them have said this is too much and tried to give some of it back. It's never enough. And so on your worst day, like we want to deliver as big of a promise and a benefit to make it as easy as possible to go through this just horrific event as possible.
So I want to make sure I want to transition this to the products, right, which is the main topic for today. But I do want to make sure that before we transition there, we kind of make a statement around, like, when we're looking at the life insurance, it goes inside of a plan, right? So there is no one size fits all, just like any other financial plan out there is not a one size fits all. So you should definitely have a conversation with your professional around the planning side of stuff, making sure that this is fitting inside of the bigger picture, which goes into the product, Mark, right? So as we now transition into the different products, right? If you wouldn't mind kind of starting us off with what's the 101 like level around like the different life insurance products that are out there.
Certainly. Yeah, no, that's a great question and a good place to start. So when we're talking about life insurance and protection in that vein, there are two main types of life insurance: term and permanent. Term is exactly what it sounds like. It's there for a period of time. It is not there forever. It will expire at some point, but it provides a tremendous amount of protection during that period of time. The other side of that is permanent insurance. Again, just like it sounds, there forever for the rest of your life, meant to be there on the day you die to pay a benefit out to your family, whether it's, heaven forbid, something prematurely, or more likely when you live out to or beyond your life expectancy and you pass away. We want that death benefit to be there. And Ryan, as you alluded to just a moment ago, certainly things change over time. And that permanent life insurance is malleable. It is often adjusted one way or another as time goes by because your needs are going to be different. I'm 44 years old right now. 20 years from now or so, hopefully I'll retire. And man, I sure hope I live another 20 beyond that. And my needs will change. But I'll tell you right now, I will always have life insurance in place, whether we're talking about 45, 65, or 85.
You
Or
said
beyond.
your age just to mock me, didn't you? Because of our prior conversations around I'm
I
older
brought up
than
my
you.
age, not
No, I
yours.
appreciate that. Thank you. Uh,
But at your age, I'm impressed that you remember that from earlier. So thank you. Very, very
I'm thinking of no.
And Mark, it's also important to notice that, or to note that, while permanent insurance it's permanent from the insurance company's standpoint, you brought up the point that it's malleable, meaning that it's changeable and flexible from the client's side of things. So there is choice and flexibility when we talk about permanent insurance. And it's important to note that whether we're talking about term or permanent, anything life insurance is all about the death benefit first and foremost.
Absolutely. Protection first. I agree. And so I'll try to stay away from the $5 word. Sorry, I got a word of the day calendar. Malleable was today. So but you make an excellent point. Permanent is permanent from the insurance company's standpoint. In order for something to be permanent for the client, for the policyholder, we really have to study that policy and take a look at the terms and provisions, because within the permanent umbrella, so to speak, there are two main types of permanent insurance. There's whole life and there's universal life. Whole life is generally somewhat straightforward. It can be changed, but it's built on a core of guarantees, and we can talk more about that in a little bit. And then universal life is a very different animal. It is considered permanent insurance, but it's available in a few different flavors, so to speak. There's a few different wrappers around that core universal life chassis. If it's okay with you guys, I can give you an analogy perhaps to understand a little bit about universal life insurance, if you think
Please.
Yeah.
that's a good fit here. So when I speak to clients and talk to them about universal life insurance, I use the analogy of a bucket. Universal life insurance is a bucket that you are contributing premiums into and building up cash value. So we know that there's death benefit protection. Let's say it's a $1 million universal life policy. If God forbid something happens, $1 million is going to pay out tax free to the beneficiaries. But during the lifetime, the policy owner is paying a premium into that bucket every single month or every single year and building up cash value within the bucket. So let's say the premium is $200 a month, and every month I'm putting in $200 and it's building up 2, 4, 6, 8, etc. Great news. There's also an interest rate attached to that bucket of money that is growing and allowing the money within the bucket to grow. That's where the different wrappers of universal life come in, because that interest rate can be tethered to a few different things. There are fixed universal life policies where we're talking about bond interest rates and nothing attached to equities or stocks or securities. There's variable universal life insurance where the interest rate is tied directly to how the market performs to a certain, depending on your choices, your sub accounts, they are called, which are very similar to mutual funds. Lots of upside, lots of downside to that as well, which means your money in that bucket can grow, but can also shrink if the market is in a negative place. And there's also indexed universal life. Indexed universal life gives you guardrails to that market performance, meaning there's a limit to how low it can go. So that policy may say, hey, the interest rate that you earn can't go below 0%, but there's a cap. And they'll say, well, the interest rate that you earn also can't exceed 10%. So if the market is down by 5%, you're at zero. But if the market is up by 25%, you're stuck at 10%, despite how that performance has gone. Thus far, I think that sounds pretty great, building up cash value and building interest. But what you really need to be cognizant of is there's a hole at the bottom of that bucket on the underside. And out of that hole, every single month shakes a little bit of money. And that is your cost of insurance, your management fees, what it costs for the insurance company to maintain and service that policy. Every month, a little bit of money is coming out of the bottom of the bucket. And the hole at the bottom of the bucket, this is the crucial part of universal life. The hole at the bottom of the bucket is getting bigger every single year until the day you die and never stops growing. So perhaps in year one, it's the size of a pea, then it's the size of a dime, then a nickel, then a quarter, then a silver dollar, etc. It gets larger and larger. At the beginning, when I'm contributing that $200 a month, like I said, perhaps the cost is only $20 a month. So my net gain in the bucket, without considering interest, is $180. But as the years go by, eventually that cost of insurance will exceed the $200 per month. And now our hope is that you have built up enough surplus so that your $200 a month contribution can sustain the 225, 250, et cetera, that's coming out of the bottom each month. And I apologize if I'm getting too technical too quickly, but I do think that increase in cost of insurance is a crucial part of understanding. Without getting into quite yet the specifics of how the interest rates can change, the cost of the universal life policy growing is important to understand.
100%. And like now when we compare that with, say, the other side that you talked about, whole life, the whole life still has the hole in the bottom of the bucket, right?
Well, whole life is a very different animal as compared to universal
Mark?
life. Yeah. Can you hear me okay?
Yeah, sorry, you cut out for just a second there.
Okay.
The whole life still has a hole in the bottom of the bucket, right?
There's no hole at the bottom of the bucket on whole life insurance. It's a very, very different animal than universal life insurance. So before I shift over to whole life, I don't want to make it sound like it's all gray clouds and storms when it comes to universal life. I do think that all types of insurance are appropriate depending on the situation. And some of the advantages of universal life are that you have extraordinary premium flexibility. So if you have built up a surplus and let's say your bucket is currently holding $10,000 and you want to take a premium break and not pay that $200 a month for maybe 6 months, you can do that. You can turn off your premium. Universal life is flexible that way. Now, what most people don't pause to consider when they do make those changes is that there's going to be a long-term impact to your policy. You stop contributing $200 a month for 6 months. That is going to potentially dramatically impact the long-term projection and performance of the policy. Does that mean you'll have to increase to $210 a month later on? Does that mean that your policy will not last as long as you had planned on because the bucket will run dry too soon? We don't know. You have to assess when you make those changes. The other positive aspect of universal life is that the money inside that bucket is very liquid. The client, the policy owner, has the ability, we'll use the $10,000 analogy, and say, well, I need $2,000 right now for whatever reason, whether it's an auto repair or something else. You can, I like to say, just scoop right into that bucket and take out the $2,000. It is entirely liquid to you. Something to be aware of for universal life in the early years is that there are surrender charges on a universal life policy. If a client, or if you as the listener here are looking ever at an insurance proposal for a universal life policy, you may see two different columns for cash value: policy cash value and policy cash surrender value. So it may say, well, your policy is worth $10,000 in cash, but right now at this point in time, your surrender value is only $6,500, for example. That $3,500 is surrender charges. I don't care what the cash value is in the policy. I care what it's worth to me. The surrender value is what you want to look at when you're looking at a universal life policy. The 10,000 is all used for charges and it's all there in the policy, but you don't have full access to that until enough time has passed that the surrender charges have gone away. And I know, again, that gets a little technical, but it is a crucial understanding. Now, I have seen clients literally in tears because they thought that their 5-year-old universal life policy that had $30,000 in it was worth that to them, when in fact the surrender charges were still so high that it was worth under 10,000, and they couldn't access the money that they needed. Not a poison pill, not the worst thing in the world. You just need to go into your policy with eyes open and an understanding of what protection you're putting in place and what impact it can have.
I mean, and that's the critical point about all of this stuff, whether it's universal life, whole life, term. Understand what you have and how it works over time so that you can understand what it's designed to do and what it's designed not to do.
Absolutely. Absolutely. So now I think we can pivot to whole life insurance to try to understand how it differs and what the positive aspects of whole life are. The starting point of a whole life policy that I will always convey to someone is that there are 3 core guarantees to whole life insurance that are always found in tandem. Guaranteed level premium. When you buy a whole life policy, your premium is not going to increase. There's not going to be a point where the insurance company says, we know you were paying $200 a month before, but now to make sure your policy stays in force, we have to keep it to $250 or increase it to $250 rather. That does not happen. Guaranteed death benefit. Your policy will stay in force. Your death benefit will be there if you pay your premium. Doesn't matter what markets do, what bond markets do, what happens with anything else. It is guaranteed. If you pay your premium, your policy is there. And third, guaranteed cash value. If you pay your premium into your whole life policy, your cash value is going to go up by some extent, and that is on a guaranteed basis. I cannot, or I have not yet in my career found all 3 of those guarantees in tandem on any universal life policy. I have only found all 3 together on whole life insurance. I can find you 2 out of 3 for universal life, most likely, right? I can show you some great guarantees on death benefit and a guaranteed level premium together, but likely little to no cash value. That's called a no lapse guarantee or a secondary guarantee universal life policy. With whole life, when you pay those premiums, you're going to build cash value and your death benefit is going to stay in force. When you purchase a whole life policy from a mutual company, and I will generally strongly recommend that an individual, when they're looking at whole life, look at a mutual company, not a public company. And I won't go off on a tangent of horror stories of companies past or naming any names, but there have been some rough waters for people that have had whole life through stock companies. When you buy whole life through a mutual life insurance company, you're not gaining additional cash value beyond the guarantees based on market performance. You're actually tethered to the mutual insurance company that has put the policy in place. They pay out something every year called a policy dividend, which is a share of the company's profits. Policy dividends, and I want to make this clear, policy dividends are not guaranteed. They are a contractual provision of the contract. But without looking at any company in particular, the major mutual life insurance companies in America, most if not all of them, have paid out policy dividends every single year for well over a century consecutively. So they are quite good at it, even though it is a non-guaranteed perspective. And that's, again, tied to company performance. Every single year, the insurance company will declare a policy dividend, a great big pie, and they say, well, there's $1 billion dividend. That's net of expenses, net of any compensation paid out, salaries, keeping the lights on, whatever it is. We have ended up with $1 billion. And a mutual company isn't owned by shareholders. There's no stock. So that $1 billion pool, that dividend, is only shared with the whole life policy owners. When that is taken into account, we look at the insurance company looks at each participating whole life policy and figures out what slice of that $1 billion pie each policy receives. But again, not tied to market performance, and in addition to the guaranteed cash value that you're already getting.
Versus when it's not a mutual life insurance company, now the policyholder isn't first in line for that dividend, right? Now the shareholders are first in line for that dividend, which is what you're bringing up as a big concern around that.
Absolutely, yes. And no one will ever convince me otherwise. Any company that is public, their first concern is always their shareholders.
Yep.
Regardless of what product they're selling, what policy they're putting in place, whatever it is, the share price is always paramount. Those quarterly earnings calls that take place, they want to make those shareholders happy first and foremost. And when we're talking about permanent cash value life insurance, especially whole life insurance, we're talking about a long-term perspective here. We expect people that purchase a policy to hold on to it for the rest of their lives. And insurance companies are trying to build products that provide the best possible long-term return. It's much easier to do that as a company when you can take a long-term perspective and plan 5, 10, 20 years down the road and have long-term perspective and long-term goals and trajectories versus having to prove yourself to a group of shareholders that may not even be policyholders on a
Yep.
quarterly basis. Yeah, it's not the same thing. It just flat out is not. I'm not saying it can't work. I'm not saying that every stock company that sells whole life insurance is doing wrong by their clients. Nothing of the sort. It's just simple logic and fact. If there are shareholders, they come first, and they don't have to be policyholders. And if you're a policyholder but not a shareholder, you're coming second in line at best.
Right. So, Mark, you mentioned the universal life, right? You've got they've got the cash value growth, you've got the death benefit, but you have the flexibility of the premium, right? And then in the whole life, you said there's a level premium. You've got the cash value and you've got the benefit and the guarantees that you spoke into there. But what about the flexibility of the premium on the whole life? How does that compare?
Yeah, it's a common misconception that whole life is completely rigid, completely inflexible, and once you're locked in, you're locked in. And if you don't make your payment, that's the end of the road. That is just simply untrue. There is absolutely flexibility within a whole life policy, especially as the years go by and time passes. So we can let's talk about some of those things that make the policy flexible. The base guarantee or the guaranteed cash value of the contract is available to you, and you can access that guaranteed cash value in the form of a policy loan. So if we'll use the same example that I used before. We have $10,000 of cash value in the policy, and I want to take a 6-month premium break and not pay that $1,200. The policy has the ability to borrow against itself, and you not have to pay that premium in full for that 6-month period. So after 6 months have passed, now instead of $10,000 of cash value net to you, there's $8,800 approximately net to you because we've taken a $1,200 loan and there is an interest rate associated with that loan as well. However, that's not the only way to access cash value within the policy. I just told you all about policy dividends and how a whole life policy owner shares in the profits of the insurance company. That money is completely liquid to the policyholder. So if we have built up $10,000 in cash value and $8,000 is guaranteed, but $2,000 is from dividends, then we can take that cash value and we have the ability to surrender those policy paid up additions. That policy cash value. I'm using technical terms already with paid up additions. I didn't mean to. We have the ability to surrender that dividend cash value within the policy rather than take a loan. What's beautiful about this is the flexibility of choice. You can choose to take a loan because that $1,200 need is very temporary, and after 6 months you'll be able to pay it right back. Or you can choose to say, I don't want to make up that difference. I just want to take the cash value that's within the policy and use it to pay the premiums. We can do that as well. Much like universal life, as I alluded to before, this is no different. You want to look at what the impact on your policy is going to be, hopefully before you take that action. All too often, we see policyholders that take action and then ask after the fact, hey, what did I do? And I will always encourage every policyholder of any type of policy, before you take action, it's not about calling the 800 number that's on your statement. Call your financial professional before you take action. People at a customer service line are not trained nor allowed necessarily to advise you on the impact of the action that you're taking on your policy. That's why your advisor is there. That should be your first call, not the 800 number.
And Mark, that's not true of life insurance. That's true of just about any financial decision. Like, Americans are great at making financial decisions off the top of their head and then going, hey, wait, what did I just do? Figure out what the ramifications are prior to actually doing them.
Mm-hmm. The first question should be, what is this going to do? Not what did I do already?
So when we're looking at, you mentioned the level premium, like you mentioned the cash value, the flexibility, so right, they're both have some pros and cons there. But when you mentioned the level premium and the whole life versus a universal life, if we're comparing like apples to apples in terms of just death benefit alone, typically, correct me if I'm wrong, the whole life insurance would be a higher premium than, say, the universal life for the same benefit. Is that an accurate statement?
Well, it depends on how the policy is designed and presented on the universal life side. On with whole life insurance, your death benefit choice dictates your premium immediately. If you're purchasing a $1 million whole life policy from an insurance company, they will tell you this is the amount of premium that you need to pay for this policy every month or every year, because the policy is designed to stay in force until age 121, guaranteed. The insurance company is telling you this is the amount that is necessary to keep the policy in force on a guaranteed basis. Guaranteed means no dividends. And we just said that the insurance company pays dividends pretty consistently and regularly, but that's what guaranteed means. So that's why that premium is dictated in that way. It's possible that you won't have to pay for that full lifetime amount of time, or possible that things can change, but it's designed on a guaranteed basis. Universal life is very different. The only requirement for a universal life policy to stay in force is that the bucket that we talked about before holds enough money to cover 60 days of internal expenses. That's the requirement. That's the baseline. So the insurance company and potentially the advisor can design that universal life policy with a premium so low that you're constantly scraping up against the bottom of the bucket and just barely keeping it in force. Now, the flip side of that is a great universal life policy and a great advisor that puts one in place is going to have their client pour as much cash value as makes sense into that policy, so that the bucket is always robust and comfortable and building great value. We alluded to, or I mentioned, variable universal life insurance before, where you are tied directly to the market. Sky's the limit. You can't see where bottom is, right? So
right.
I'm assuming that most people are somewhat at least familiar with investments in the stock market and the ups and downs. That means that for variable universal life to make sense, in my personal opinion, you really, really need to be young enough that you have a long time horizon to be able to build up cash value. You need to be comfortable overfunding the contract, because you have to be able to weather the storms, so to speak, of the market. Market's always going to go up and down. Historically, they've traditionally been up more than down, but you got to weather those down times. And then, speaking of weathering those down times, emotionally, you as an individual have to be comfortable with market performance. If you wake up one day and see that the performance on your policy has dropped significantly, do you have the fortitude, so to speak, to say, you know what, I know long term this is a good thing and I can ride this out? Or are you the type of person, and it's not a criticism, some people are that type of person that says, well, this is too much of a gamble, this loss has scared me, I need to get out of this thing and do something different? If you know intrinsically that you are that person, then perhaps a variable policy is not the right solution for you. It's a little bit too much risk for, again, we're not talking about an investment. This is protection, likely for your family, to ensure that if something happens, there's money for them, and you want to know that's going to be there. That doesn't mean that variable universal life is bad, just means that you have to structure it appropriately so that the policy is there when it's needed.
Now, is that similar for like an IUL as well, or an indexed universal life?
Indexed universal life, it's a great question. It is a different brand of universal life insurance. And with a different brand comes different provisions and nuances to be aware of. So again, just a reminder for our listeners, with indexed universal life, you have that floor and that ceiling. And I use the example, and I'll stick with it, of 0% being your floor. So market performance won't be below zero. That does not mean you are guaranteed in any way against losing cash value, because the hole at the bottom of the bucket is still there. So if you're not earning any interest, those expenses are still coming out, and that nets a negative return for that given year. And then we have our cap, and I use the cap, the ceiling example of 10%. The cap is not guaranteed. That 10% cap is not guaranteed. So the insurance company has the ability, and they do this regularly, to change the cap. It can go up, it can go down. There's a guaranteed cap, and usually when you look at your contract, an IUL contract, the guaranteed cap is somewhere in the 2 to 4% range, depending. Some of them are lower these days, but we won't get into the nitty gritty of product design. I'll just stick with the 2 to 4% example. But I don't care if it's 4%. 4% isn't 10. And when you're buying a policy at 10, if it did go to 4, that's a pretty significant difference within the contract.
Yeah, so I'm really kind of wrapping this all up, right? The term insurance, for the most part, is relatively simple to understand. It lasts a certain amount of time for a specific benefit, and then it'll expire. On the permanent life insurance side, there's several different flavors, and the design work of the policy, as well as how it fits into your actual financial plan, that's where working with a professional and these types of conversations need to be more involved, and understanding how it fits inside of the entire financial plan. It's not that any one of these policies are better than the others. It's how it's designed and how it fits in your specific plan.
Exactly. That's exactly right. I've said this many times before, and I believe it to be true. All insurance products can be used for good or evil. It depends on the person that's actually designing it and what they're doing with the overall financial plan for the individual. I have seen in my nearly 20 years in this profession, horrifically designed universal life and whole life type contracts, and I have seen beautifully designed universal life and whole life contracts, and everything in between. It is about the overall portfolio and working with a professional that understands the products that they're working with. If you have questions about your policy and your advisor, your financial professional is not able to provide you with answers, and they may not be able to on the spot if you have a very detailed question. None of us know everything about everything. But if your questions feel dodged, if you feel like you can't get a straight answer, if you feel that little tickle in your throat that says, wait a minute, this doesn't feel quite right, this is a red flag, dig a little deeper. Get the answers to those questions. It is crucial that your financial professional understand the type of product that they're putting in place for you, so that you can understand the type of product that you are putting your hard-earned dollars into every month or every year in the form of policy premium.
Love it. Well, Mark, I appreciate you being on the show. This has been awesome. I think we need to have you come back on again to
sure.
go even deeper on some of the strategies that
I would love to.
in this. So
I appreciate
thanks
you having me.
again. Yeah, absolutely. For those listeners, right, head over to beerandmoney.net, and if you have any questions on today's episode, or any questions on your mind, just in general, financially related, at the top of the beerandmoney.net page, there's a contact us. That's a great way to reach out to us with that. As always, we hope this episode was valuable for you. And Mr. Collins,
cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
81230020.1, expiration date June 2027.